Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. It's December 2nd, and it's about 8:06 in the morning. The market's going to gear up to open in about an hour and 24 minutes, to be specific with you. It's so early, I could barely speak this early in the morning this fast. You know, it's like my first wave of talking in the morning. So I'm sorry if my mouth is still catching up to my mind. And folks, I really want to appreciate the wonderful feedback, the nice comments, and all of the support you've been giving us. Please, please, please comment below the video in the YouTube Wealth Press channel. I really appreciate it, and I will respond. And a lot of times, people are asking really good questions that are impacting and helping others. Now, the market, as I said, is going to open up in about an hour and 23 minutes. So far, everything is slightly negative. This is really randomness. This isn't really any major directional bias. But as I mentioned, this market is grossly overbought. Now, today's Friday, and I want to mention something about algorithmic trading. Before the year 2005, 2004, you wouldn't see these kind of run-ups on low volume. These are mostly algos trying to confuse the little guy, the retail trader, that the market's going bullish. And it's also flight to quality. But what I'm seeing here right now is, notice the uptrend. Notice how divergence is moving lower. Divergence is one of the best indicators. It's not only overbought like it is here, but it's also diverging, which is telling me there's a real strong odds that the Dow is going to undo most of this. Now, why am I so confident in that? Let me show you why. The Dow only has 30 stocks. The S&P has 500 stocks. If you look at the same graph on the S&P 500, you will see that we're just kind of sitting right at the 200-day moving average. It's a lot harder to trigger algos on 500 stocks than it is on 30 stocks. So that's one of the major changes that we've seen with algos. The highs tend to get higher and the lows tend to get lower before the market corrects itself. As I was showing you guys a few months ago actually, when we had a double bottom, in the old days, double bottoms looked like this. This is actually pretty interesting. So it would be called a 1, 2, 3 pattern. You would see a 1, 2, 3, and the second bottom, that's the first bottom. The second bottom would be higher than the first bottom. So you would have a 1, 2, 3 with the second bottom lower, and then that would tell us that it's a good time to start buying. Now you have this type of an environment where the lows, the second low is actually going lower because algos are pushing these prices lower. Algos are doing that to stop out, trigger stop losses here, and then take the market higher. So you notice the difference, a real major difference. And this is a perfect example because you have two scenarios on one chart. So algos really confuse the markets now because the levels we used to be getting used to things are no longer there. So for example, a lot of traders are like, oh, we're entering a real bull market here. We're above the 200-day moving average. Folks, this is danger zone right now. I mean, look at the QQQ. The QQQ, which has all of the tech stocks, can't even get up to the 200-day moving average. So do you think in a bear market, the Dow's going to lead us out of this, just flying with rainbows and all that? Come on, and butterflies. Let's be real here. It's going to revert back down. You still have a huge vulnerability in the market. I mean, look at this. Look at this. 54, 26, 36, 53% of stocks. That's a lot of vulnerability right now. So you got to be very careful. Also, when I talk about vulnerability, I want to show you guys something. I want to show you how overbought the Dow is right now. Now, I want to show you that this is something for the books actually. So look at where we're at right now on the Dow. The only time we've been here was right here, February, March 2016. In 17 years, this is as far as back as it goes. Look at that. Higher than any other level other than this. Folks, that's danger zone. And on the S&P, it's right here, these two levels. So right now, I'm becoming increasingly bearish on the market. Now, the bond market also looks to me like it's going to peak out a little bit. I know the bond market's getting really happy because the Fed is only going to raise rates double what it usually does, not triple. So I think the bond market is topping out. I think most of that is already assimilated, and we actually took a short position. We should have waited till the end of the day, but I'm an eager beaver. We took a short position, And I'm waiting for this to revert lower, but I think the bond market is going to stay within this channel, and stocks are going to start seeing some selling pressure. Now let's talk a little bit about momentum in the S&P. This is S&P. This is what I was just showing you. And look at where we're at. The only time on the S&P we were here is the recovery from COVID, that big downside, and then we had another big downside, and here we are now. So folks, this is not, I repeat, this is not sustainable momentum. And with the bonds dropping, it's going to put a little more pressure. I think the bonds are overbought and going to start coming down. That's going to put more pressure on the stock market, on the overall stock market. Now, let's talk a little bit about the nitty-gritty. Let me talk about the manufacturing. So data, Fed data. Mixed economic data yesterday emphasized weak manufacturing activity. Manufacturing activity weakening is not positive for the economy. Consumer demand is still strong as a key to non-farm payroll, which is still the only thing really holding the market up, in my opinion. U.S. manufacturing activity shrank for the first time in 2.5 years as high borrowing costs weighted on demand for goods, indicating that the Fed rate hikes have, in fact, cooled the economy. I mean, that's kind of obvious. Personal consumption expenditure price index was in line with expectation. That's why I think the Fed is being so aggressive, because spending is still there. Underpinned by lower fuel prices, which is really helping us out. Labor Department reported on Thursday that claims for state unemployment dropped 16,000 to 225,000. That's stronger than expectation of 235,000. And we have a major employment report coming out in about 17 minutes, just FYI. The future rate hikes. Remember, I talk about these probabilities every day. We're now back at about 80-20, and I think over the next couple of weeks, as the market starts cooling off, we're going to see higher on the, I think by the time the next Fed meeting comes, this will be back at 30, and 50 basis points will be at 70. But I think I'm pretty sure they're going to do 0.5 in December, unless something drastic changes. Today, we're watching the non-farm payroll data for clues about the Fed's aggressive rate policy. They're predicting non-farm payroll to stand at 200,000 compared to 261,000. The number ahead of this, which was the ADP number, was awful. I mean, this number was awful. Let me just show you. That kind of reflects, they were expecting 200,000. They got 127. So I'm very nervous about that. And also, and this is what I'm looking at actually, I'm looking at the unemployment rate, which was at 3.7, and they're looking for it to be at 3.7. I think unemployment rate is going to go up a little bit. In Europe, stocks are up slightly after the release of key U.S. jobs data. It caused them to rally. Eurozone inflation dropped by more than expected to 10% on an annual basis, which is huge, but remained well above its 2% target. As I said, 10% versus 2%. I don't know what they're smoking up there, but that doesn't sound like happiness to me. The Shanghai closed lower as investors wait U.S. payroll data, but report that revealed that country's plans to remove its severe anti-COVID measures help limit losses. Reuters said that China is set to declare an easing of its COVID quarantine protocols and a reduction in mass testing in coming days, indicating a shift in policy. That would be really helpful, and that would boost us a bit. Japan was lower, weighted down by banking, insurance, and power sectors. Now, as I mentioned, I think the bond market is going to start cooling off. Also, if you look at the stock fetcher, if you look at the 11 major sectors, financial looks like it's doing okay. Energy looks like it's still kind of rocking and rolling and congesting. Utilities made a higher high yesterday. Healthcare made a higher high yesterday. Technology made a higher high, but I wouldn't be holding my breath. But if you look at most of these sectors, like discretionary, communication services, I think this is just a topping out pattern. Let me show you what I'm talking about. If you look at XLC, you will see that it's kind of right now creating another channel. And I think it's going to remain in this channel for quite some time. I think that stocks are going, they just drifted from here to here, but I'm not seeing this regaining upper exposure. I think communication sector is going to sit in a channel as well. Also, small cap stocks are not really moving just yet. They're still near the bottom. And until we see more accumulation from small caps, I don't think the market's gearing up to do anything. Volatility levels, let me show you volatility levels, are starting to rise again, and I think volatility has bottomed out. I'm actually considering buying a call, but I want to wait for sentiment to change a little bit because we may be near these levels for quite some time. Overall, I still believe the algos is what's causing the Dow, the rally in the Dow. The algos are trying to confuse retail traders, and they're pushing the Dow a bunch higher right now. But again, if you look at the momentum levels, I think there's absolutely no reason at all, especially with energy prices being a little subdued, for the Dow Jones to be above the 200-day moving average. And because that is a bull market, with the overbought level, I think we're going to cool off quite a bit. And I mean quite a bit. I wouldn't be surprised if we lost all of the gains that we got from that 700-plus gain day this week before next week was over, because I don't think the market has what it takes to hold on. Now, next week, folks, you got to pay big attention on inflows, fund inflows. I was reading an article last night. I'm actually going to talk about it later today, that hedge funds, the largest institutions, used this opportunity to unload about $8 billion worth of securities, SPY ETF and a couple of other ETFs. So funds did not use this as an opportunity to accumulate. They used this as an opportunity to liquidate. Big difference. And I think the market, most of what these outliers that we're seeing are caused by algos. And I think the market, once it assimilates the fact that we are not, in fact, becoming bullish anytime soon, it'll revert back down, and we're going to see a reversion of all of this back to the bottom. Again, I hate to say this, but that's reality. Now, folks, today is Friday. And I want to let you know that Lance Ippolito, you guys know Lance Ippolito. He's one of my, we work together. He's one of the gurus at Wealth Press. He's our resident expert on insider activity. He's hosting his famed unusual option activity training today at 1:30 Eastern Time. And let me tell you something. Right now, you want unusual option activity because there's so much squirrely stuff happening in the market with this volatility. So Lance will at least tell you where the good money, the quality, the quality money is moving into, the smart money is moving into, and which stocks are just being driven by junk. And that's happening a lot because of algos right now. Now, this is the last time, or actually, the last time he hosted this session was February of this year. He wants to do it again before the end of the year is up. And to this day, it's one of the most popular, exciting, and asked for training sessions at Wealth Press. You do not want to miss this out. He's covering a repeatable, duplicatable way to track and trade unusual option activity using nothing but some free internet tools that anyone has access to. You guys are going to love this. And he'll detail how to leverage unusual options to often end up on the right side of some incredible news-driven stock moves. He's caught some really big moves this year. You don't want to miss out. He's very active, and he's telling me, we've been talking, and he's telling me there's a lot of unusual option activity that's happening right now behind the scenes. You do not want to miss out. The last thing you want to do is miss out. So follow the link below this video and get in on this right now. You don't want to miss it. 1:30 p.m. Eastern Time today. Lance Ippolito, unusual option activity. He hasn't done this training since February of this year. Very much in demand. Doesn't cost you anything. No tricks, no gimmicks. Check it out. And remember, post your comments in the YouTube Wealth Press channel, and I'll see you guys on Monday. Have a great weekend. And if you have any questions, support@marketgeeks.com. Bye, guys. Have a great weekend.